My name is Dr. Ola Brown, and today I'm going to talk about a trend I'm seeing in the VC industry that I think will become more common, and it's the private equitalization of venture capital. Or the way that I'm seeing it, private equity is becoming a bit more like venture capital, and I'll explain why in the next few slides. But just to give you some context, I'm going to give an introduction, I'm going to give a brief history of venture capital, I'm going to talk about private equity operations, the difference between PE and VC, and the new normal for VC firms. So just by way of introduction, my name is Dr. Ola Brown, I'm the founder of HealthCap, and I'm an experienced venture capitalist. I've worked in venture capital for 10 years, or almost 10 years now. I've invested in over 30 companies. My first fund was a generalist fund. My second fund is focused on fintech and health tech. I founded HealthCap because I'm super passionate as a medical physician with a master's in finance, doing my PhD in finance. I'm really focused on fintech and health tech, health and wealth as real enablers of prosperity and jobs on the African continent. So a bit of an introduction. When I talk about the private equitalization of VC, what do I really mean? I think that VC is evolving, and I think that one of the way that it's evolving is becoming a lot more like private equity. And why is this important? I think it's important for VCs to notice these changes. I think it's important for founders to also be aware of these changes. VC has always been seen as a subset of private equity, or typically traditionally been seen as a subset of private equity. So I wonder whether these changes that VC is currently undergoing will make us more aligned with the private equity world, or whether we'll kind of still continue to be very differentiated sectors. So I'm going to do this by sort of tracing the history of venture capital from sort of its kind of humble beginnings to where we are now. So in terms of the historical context, it's Professor Tom Nicholas from Harvard Business School think that the origins of venture capital actually come from the whaling industry. So in the 1850s, whaling was a big business. People used to go out and kill whales. And all of the merchants used to have to invest large amounts of money in these teams of whalers. So in the 1850s, it became sort of a big industry or a big sort of body of knowledge to know all of the individual members of the whaling team and their skills. Because the likelihood of one of those kind of small 1850s boats going out, spending 3 to 6 months on the ocean and coming back with a whale was quite small. But if they managed to catch a whale, then the returns were exponential. Every single thing about the whale was useful. Whether it was the whale oil or the bones or the blubber, every single thing about the whale was valuable. And that's why it was such a high risk but high return industry. The process of catching and killing a whale at that time, so before there were guns, was with sort of knives, little arrows. So most of the crew, even if they actually found the whale, which was one thing, so finding the whale was one thing, there were no sort of sonar detection devices for whales, so they had to basically wait and sail around until they found the whale. But sometimes in the process of trying to kill the whale killed them, and you can imagine trying to attack a massive whale with like little almost kitchen knives, which was the kind of situation that they were in. Sometimes they were also killed just by stormy weather. Remember, there was no navigational equipment that we have today, so a lot of them were killed in storms, some by dehydration, some because they ran out of food, some by cannibalism, which was very common on these expeditions. So, but if they actually brought back this golden goose, this whale, then all of the merchants that invested in them would become very, very wealthy. So it was a high risk, high return business, kind of like venture capital. So over time, obviously, venture capital became more about investing in tech companies. This was the the earliest sort of venture capital-like investment, but the earliest sort of venture firm was actually founded probably in 1946, and it was called the American Research and Development Corporation. And the founders of ARDC were called the Traitorous Eight. They were a group of mostly PhD students or graduate postdoc level researchers that knew a lot about technology. So they were called the Traitorous Eight because they were quite treacherous in that they left their boss to form this company called ARDC. And they invested in things like the digital equipment company. For example, they invested $70 million in the digital equipment company, getting a 77% stake in that company in 1950 or 1957. And eventually the company's value increased to about $400 million. So that was, quite a strong exit at the time. They invested in, or they had the origins of companies like Intel, for example, can be traced back to the Traitorous Eight. So extremely famous group of young men at the time, PhD holders, highly educated, sector experts that really formed the origin of the venture capital industry that we know today. So, history repeats itself. We find ourselves in a situation where history is repeating itself. And, COVID-19, again, raised the prospects of technology really driving the future in an exponential way, aided by some of the expansionary monetary policy that we saw, zero interest rates, making everybody want to invest in venture capital. And this was the venture capital boom. And then we had the venture capital bust in 2022. Less funding went into VC, and of course, there was a market correction. So what's the new normal? Before I talk about the new normal, I'll just talk about private equity. So private equity firms, the private equity industry is significantly larger than the venture capital industry. And private equity firms make direct investments in private companies and usually take a majority stake. Sometimes you see them taking a minority stake, but usually tend to take a majority stake, whereas a venture firm wouldn't typically take a majority stake in a company. So they typically purchase large stakes at valuations of at multiples of profit. So the way a private equity firm would typically value a company is they'd look at how much profit they were making and then make that investment at a valuation of the profit. Now, private equity investors can invest in 20-year-old companies. They can invest in 30-year-old companies. They can invest in 50-year-old companies, second-generation companies, for instance. It's not necessarily focused. They can occasionally invest in startups, but these companies tend to be older and more mature and more established with long sorts of years of financials and usually making a profit. Now, there are all different types of venture capital of private equity firms. Some do specialize in technology, but you find sort of the majority of private equity firms investing in older, established, large companies and investing for large stakes. So the big difference is the stage of investment. Primarily, private equity companies focus on later stage companies that are large, and they take ownership control. Typically, I've seen private equity companies take minority stakes, but usually they take ownership control. And then in terms of the risk and return profile, the risk they take is lower because these companies are large and established, but also the returns tend to be lower as well than venture capital. But there are some points of convergence, and these were the points that I wanted to talk about and get us thinking about as we move into 2024. After the events of 2021, VC changed. The rate hikes happened, money started flowing out of VC into other asset classes, and VCs became more conservative. Now, some people will tell you that it's a phase, and when the market comes back up, VCs will go back to their old ways. I think that this is something more significant than this. I think that it marks the beginning of a fundamental change in the way that venture capital firms operate. We're seeing more emphasis being placed on revenue-based valuations, like private equity firms. We're seeing increased use of ordinary debt. So sometimes a startup will announce a $100 million raise, and actually 70% of it is debt, 30% of it is equity. We never used to see that before, but now we're seeing a lot more debt going into startup raises. We're seeing more due diligence. So, I mean, the 2020 venture style, what produced problems like what happened in FTX and Theranos, was the fact that there was very, very lax due diligence. And there were billion-dollar companies that had no board, and the VCs actually had no oversight over how they were spending the money that they raised. Now we're seeing a lot more due diligence, a lot more private equity style due diligence, looking in detail about the founder, team, expecting audited accounts, expecting a financial model. And I think that that is also something that will continue. We're also seeing higher levels of corporate governance. So, for example, seed stage companies were rarely asked to have boards. Now we're seeing that almost across, sort of almost universally accepted that, you know, smaller companies should have boards or should be preparing to put a board in place. And I think that this brings a lot more similarity between private equity and venture capital. Now, what do I think other changes could happen? I think that increasingly, startups will need to show either profit from the get-go or a clear route to profitability when they're seeking investments. This is something that was typical of private equity, but now we're seeing it coming into venture capital as well. In a low interest rate environment, companies could raise venture capital with little regard for fundamentals. But now the value that a venture capital firm can bring beyond cash is really important. So in the current environment, I expect venture firms that specialize in assisting founders in ways that are unique will differentiate themselves from the crowd. Now, the problem with no real fundamentals, no real sorts of expectations in terms of ARR and in terms of financials and in terms of team is that it really disadvantages women and minorities because there's no clear, transparent criteria to who can get venture capital. And it puts the chances more on luck than on merit. So now that we're seeing more need for a clear route to profitability, we're seeing more valuations based on fundamentals. I'm predicting that there'll be more diversity. You'll see more women and more minorities able to raise because now the criteria are pretty clear. And anybody that meets that criteria, which is based on merit now, not on luck, will be able to raise venture capital. And the last thing is that venture capital firms don't typically receive a percentage of profit from their companies because it was thought that all companies would be unprofitable if they were funded by venture capital. But now venture capital firms are expecting their companies to be profitable at some point. I think, and this is really risky to say actually, but I think there may be a future where we see profits divvied up or distributed to shareholders as dividends, like in any normal company. And this is something that might be really interesting from an exit's point of view, because normally when venture capital firms invest, they expect the company either to list or to be bought up by another company. And if the company can't list or can't be acquired, then the investment is a failure. But I think as we start thinking more about profit and sustainability, we'll start thinking, is a company that makes a profit and then distributes dividends to its shareholders, including the venture capital firms, such a bad thing? And is the distribution of dividends and growth really mutually exclusive? Can't a company grow fast and distribute some of its profits to shareholders at the same time? Or is distribution really an impediment to growth? Now, that really changes the entire venture capital industry, changes the mindset, and changes what success looks like. Remember, these are just my thoughts. So I'm going to tell you a bit about my firm before I close. HealthCap is the leading early-stage fintech and health tech investor in Africa. We invest in pre-Series A, so early-stage companies, and our companies already have raised $100 million in follow-on, have operations in 10 other countries, aside from Nigeria, so operations over 10 African countries and beyond. We've created 1,000 jobs, 12,000 indirect jobs, and one fun fact is that 50% of all founders within our portfolio are female. If you'd like to learn more about HealthCap, if you're an investor, then contact us on investorrelations@healthcap.co. We'd be happy to talk to you. And if you are a founder, contact us on pitch decks at healthcap.co. You don't need a warm introduction to pitch us. You can pitch us via our email address and we'll get back to you. So what have I said in conclusion? The private equitization of venture capital has substantial implications for tech founders and African GPs, as well as global GPs. And I think looking ahead, we're going to continue to see at least some of the characteristics of private equity funds creeping into venture capital. Maybe not all of them that I've mentioned, but definitely some of them. And I think that this is such an interesting phenomenon that will change venture capital as an asset class, and founders and GPs are going to have to adjust to what will, I believe, become the new normal. I hope this has been useful. Thanks for listening, and look forward to hearing your comments.